It's a beautiful day, and as good economists, we have insulated ourselves in this dark cellar so we don't get disturbed in our thinking about the real world by the ongoings in the real world. My name is Roman Eliassen, and I'm a board member of Rethinking Economics Norway. I'm very pleased to be chairing this next session, which is titled What is Money? I've been trying to grapple with this question for quite some time myself, and I can assure you that it leads to a lot of interesting things, a lot of interesting places, everywhere and anywhere, just not to a clear answer. What is clear is that understanding money is fundamental to understanding the monetary economy in which we live. The financial crisis of 2008 came as a shock to economists as well as politicians who had not paid sufficient attention to the financial sector and how it can generate instability, cycles, and crises. After the crisis, stricter regulation of banking and finance has been put in place, and economists have been paying more attention to the interplay between the financial sector and the real economy. Or have they? Do we now understand the system well enough? And have we done enough to prevent another crisis from happening soon? And does the picture look different depending on whether we look at it from an Anglo-American perspective as opposed to a Norwegian perspective? These are among the questions that will be discussed in this session by our two eminent speakers. It's a great pleasure to introduce our keynote speaker, Ann Pettifor. Ann has been recognized as one of only 12 economists who predicted the financial crisis of 2008 in a book she published in 2006 with the timely title, The Coming First World Debt Crisis. Since then, she has published two more books, Just Money, How Society Can Break the Despotic Power of Finance, and The Production of Money, How to Break the Power of Bankers, which came out last year. Ann works as a director of the think tank Policy Research in Macroeconomics, PRIME, in the UK, and she has, among other things, been an economic advisor to Jeremy Corbyn and the Labour Party. When I mentioned at Sunday dinner that I would be chairing a session with Bjørn, Skogstad, Aamo, everyone became really intrigued, and they started listing his whole CV to me. Bjørn was the Deputy Finance Minister from 1973 to 79 and 86 to 89. Most notably, perhaps, for this session, he was the head of the Financial Supervisory Authority of Norway, Finanstilsynet and Kredittilsynet, from 1993 to 2011. He has also been the president of the Financial Task Force, and he's now professor to emeritus at the University of Agder, and has written a book in 2016 called Læring fra kriser, Learning from Crisis. Ann will speak for 45 minutes, giving her keynote, followed by a 15 to 20 minutes comment from Bjørn, before we open the floor for discussion the last 30 minutes or so. So welcome, and Ann, the floor is yours.
It's a pleasure. It's a wonder to be here because I've just flown in from New Zealand. And I didn't think I would survive. I didn't know what the day was this morning. I thought it was Saturday, but it turns out it's Friday. Anyway, I'm here, and I'm really glad to be here, and what a beautiful place this is. I want to just say this before I begin. I'm not an academic, and I have no intention of becoming one or being one. It's just not, it's not me. I'm the little girl who stood in the crowd when the economics emperor walked past and said he, because it's invariably a he, has no clothes. That's who I am. I wrote my book in the winter of 2006, and my publisher insisted on that silly title of The Coming First World Debt Crisis. I had a legal obligation to go with her. And I said, sorry, but this is published in September 2006, and by that time the crisis will have come. And the book will be out of date, I said. I was very angry because I didn't like the first world, third world moniker either. But I had no power over that. Anyway, I owe that woman big time, big time. Just the title has been enough that's why I'm here today, really. And I'm going to talk to you now I'm going to say that I think there's another crisis imminent. But what I must assure you of straight away is that the timing is something that I have no idea about. If I did, I would be John Paulson, and I will have made $1 billion bucks. But I do think that the system is still very unstable and volatile. When I wrote my book in September 2006, I was surprised at how few economists understood what was happening. And I have to say, I wasn't alone in my thinking, and I lent on some very brilliant economists for my analysis, and including Bill White, who was the chief economist at the Bank for International Settlements, and whose report in 2005 was deeply influential on me. But at the same time as he wrote that report, not predicting a crisis, but warning of extreme danger, the American administration was desperately trying to get rid of him from his post. So those were precarious times. And then what happened was, in September 2006, there was no crisis, nor was there one in January 2007. And so the months rolled by. And then on the 9th of August 2007, the whole banking system froze. There was a complete lack of trust in the global financial system, and the banks stopped lending to each other. And still, there was no recognition there was a crisis. 10 years ago, in March 2008, Bear Stearns collapsed and was bailed out to the tune of $69 billion by the United States taxpayers. And then people started talking about, well, no, we're managing this. And Greenspan started arguing, well, we can arrange a soft landing. So, all my alarmism was of no point whatsoever because, the whole thing was being managed. And it was only until Lehman's collapsed, thanks to what I think was totally incompetent policy making in October 2008, that the public woke up to the fact that there was a global crisis, right? Not just the public, but the policy makers, everybody. But, everyone stood there after that stunned. They didn't know what the hell had happened. And the thing that drives me is the fact that the public said, we thought this was all good, We'd been told by Greenspan, everybody, we were living in the great moderation, everything was hunky-dory. And when the public is ignorant of what is going on, we can't do anything. We can't change anything. We don't know. There's a huge vacuum, an intellectual vacuum. And so as a result, in my view, and it's a very humble view, no substantial change was made to the international financial architecture after the crisis, because nobody really knew what was going on. And the public they'd never heard of something called quantitative easing. And quantitative easing is just an extension of what the Bank of England has been doing since 1694. This is what the Bank of England does, right? But it was strange to the public. We didn't know what it was. We didn't know how the Bank of England could find £1,000 billion overnight to bail out the British banking system when they told us they had no money, right? But the public are not stupid, and we began to work out there's something wrong. There's something terribly wrong, and especially when we began to be punished for the crisis. And that, in my view, explains populism and Donald Trump, etc., etc. Anyway, and I'm rambling already, and I haven't hardly started on my presentation. I want to talk, first of all, about money, because Roman says that he's spent all this time thinking about it, and he's still struggling. It's really not difficult. It's really not difficult. And I want to illustrate this thing here. So I've just been across the road to Joe's Juice Bar, and I have no kronas in my pocket. And I waved this thing at a machine like this. And I got a fabulous double espresso for much more than I pay in London. And and I feel much better as a result. So what is this thing? This thing says, Mr. Joe, juice bar, you can trust Ann Pettifor to pay for her coffee. That's all it says. This is a promise to pay. As Joseph Schumpeter argued, money is nothing more than a promise to pay, right? Now, the form that the promise takes is the different thing. It's, you know, is it this card? It could be, for example, it could be a Saudi princess, and it could be a platinum card or whatever it is that Saudi princesses have, you know. And their card says to the Mr. Joe's juice bar, you can trust this woman a hell of a lot, right? She's got a lot more money than Ann Pettifor has, you know. So the card and the thing that represents that trust varies, you know. Sometimes it was gold, sometimes it was cigarettes, sometimes it was a checkbook. Today it's this, okay? But that's all it is. And when you understand that, you understand that money is nothing more than a social construct, right? And the rate of interest, its price, is nothing more than a social variable. When you understand that it's not like gold or silver or oil or tea or any of those commodities. And this is really important because the thing about money, I was going to say the thing I want to talk to you about today, above all else, is the rate of interest, which is the price of money. But I know that I'm supposed to talk about money, so we'll go back to money in a minute. The thing about money is that it is not limited in its supply, in the sense that you and I don't stop making promises, okay? We can make promises from today till the end of time, as long as we are human. We can make promises. Now, the question becomes, can we fulfill those promises? Can we be trusted to pay for our coffees? Have we got the capacity? Have we got the mental agility? Have we got the physical agility? Do we have the ecological resources to promise to pay? These are our finite limits, not the ability to promise, okay? And when we understand that the promise to pay can be infinite. I've just come from New Zealand, where in Auckland they have a massive property bubble. Why? Because they have this much land. This much. It's finite. And as Groucho Marx once said, you know, you should buy the stuff because they don't make it anymore. So the finite, limited amount of land, and at that limited amount of land is an infinite supply of global money being thrown, right? So naturally, the price is rising. And they're sitting there worrying about supply and demand of property and how to change land planning issues, and they're worrying about this and that. Should they have density or rubbish? They have this problem, which is they have a finite asset at which an infinite supply of money is being thrown. It's not infinite, as we will discover, but it's an enormous amount of money for this very small piece of land. So money is a promise to pay. It's a social construct, and therefore it should be managed. Now, one of the things, now let me just quickly see if I know how to work this system. I wanted to talk, this for me is a terrifying graph. And this is the point where I want to talk to you about economists. Because this graph is really, really scary. It's the graph of the London interbank borrowing rate. And as you can see, it has been sort of stable through the whole period when the federal funds rates, the central bank's rates have been low, and it's suddenly shot up, right? This is where it was in 2007-9. Now, the thing that I want to talk about is how economists say very little about this rate. They say very little about what is happening here. But what is happening here is terrifying. Terrifying. If you have liabilities of any kind, this number is really frightening because you've promised to pay at a certain variable rate, and that rate is now changing, right? And the debt that you owe is rising, but your income or your profits are probably not rising. So I've just been talking to 600 chief executives in New Zealand who've got to make day-to-day decisions about their borrowing costs, about their investments, about their rate of profit, about their fixed costs, And the thing they know and understand is their costs are fixed, their income is not fixed, right? And the economists are not helping them at all, because economists don't think this is a really important number. They don't really think this is an important indicator. But for me, it's like a dagger. It's like a dagger pointed at a huge, vast bubble of debt. Before the financial crisis, and the economists are arguing about this, this is where it was at the height of the crisis. Now, two things about that. First of all, economists argued that it was a very good thing for Greenspan and other central bankers to be putting up interest rates, to be taking the punch bowl away from Wall Street, right? So everybody congratulated Greenspan for being such a genius of a central banker, right? But what he was doing was sharpening his dagger. He was sharpening his dagger, and eventually his dagger punctured the bubble of debt that had expanded vastly over the global economy. Now, this is not an accepted view amongst economists, but it is something that me and my colleagues think is extremely important. And why? Well, because we're students of John Maynard Keynes, and John Maynard Keynes thought that the rate of interest was the most important policy tool in the economy. He thought that all of economic activity depended on the rate of interest, that financial crises were a result of the rate of interest. But Keynes is demonized today as someone who was obsessed by tax and spending. He was deeply uninterested in tax and spending. He was profoundly interested in managing the financial system and the financial architecture, and in particular, the rate of interest. For him, it was what he called the villain of the piece. So I start with this, because for me, this is giving us a real-time, real-world crisis, and economists are not talking about it. And by that I mean, of course, all the big bad economists, you know, the orthodox, all those very good economists, the people who I know and you know, are, of course, aware there's a threat. So let's go back to money. Now, am I going in the right direction? Yes. So money is always and everywhere a relationship, social and financial. If you have oil, as Norway does, you have a commodity and you probably have a surplus of that commodity. You can choose whether or not you want to lend that commodity to somebody else, whether you want to burn it yourself, whether you just want to put it in a big vault and hide it away. Those are all choices that you make. You only enter into a relationship with somebody else if you lend that oil to somebody else. Then you have a relationship with them. Otherwise, it's your savings, it's your surplus, it's your commodity, and you have it here. You're not in relationship until you choose to make a relationship. With money, you're always in a relationship. Money is always and everywhere a social relationship and a financial relationship. That's why, in a well-developed monetary system, you do not need to have savings in the vault. You don't need to have savings in the bank. You need to have the social and financial relationship. That's all you need. Now, that's a miracle, and it's wonderful. It means I don't have to wait for the robber baron who lives at the top of the hill to acquire a surplus by raiding and rioting and raping and whatever and getting the surplus. Then I go and beg him for the money. And then he lends it to me at a very high rate of interest, and then I try to grow a bit of corn on my field. That was what happened in medieval times. But when we discovered money, when we discovered a social system called money, that was no longer necessary. I didn't have to go to the lord of the manor, the robber baron, to borrow his savings. I went to the bank, and I said to the bank, I have a field with corn, and I know that I can grow corn well, and I know the sun is going to shine, and the rain is going to fall, and I'm going to have a harvest. Will you please give me some money, and when I've harvested that corn, I'll pay you back? And the bank said yes. It didn't matter what class you were, what sex you were, although, of course, it did very largely, but those things didn't come into it. Whereas if you had to ask the robber baron It depended on your relationship to the robber baron, whether he wanted to share his surplus with you. So money is always and everywhere relationship, social and financial. It's claims and obligations to make good on promises. It's credit and debt. And it's based on the credo, I believe that Ann Pettifor will pay for her coffee. I believe that there's a process behind this card which makes sure she gets her coffee. Credit backed by pledged collateral. Now, this credit isn't backed by collateral. It's a bank card, but it could also be a credit card, as we know, is not secured. Nevertheless, the bank knows full well how much money there is in my account, okay, and knows who I am and that I'm employed and so on and so forth. So although there isn't collateral, nevertheless, there's something behind it. So it's always backed by something, collateral, and it's also backed by a legal contract to pay. I've signed a contract with the bank. And it's also backed by the fact that if I use my credit card and I go over it, the bank can charge me 28% or whatever it is they charge these days, these usurious rates of rent, right? So we've got those agreements. Once we do that, then I can go and buy coffee anywhere in the world, right? So this is the wonder and the magic and the power of a monetary system. It needs, of course, to have the institutions that underpin it. It needs to have a legal system, a criminal justice system, a judicial system, which upholds the promise to pay, so that I uphold my contract. When I break my contract, I could go to jail. So it needs that. It needs an accounting system for checking assets and liabilities. Okay, it needs a banking system for facilitating transactions, right? What else does it need? It needs a central bank, which is fairly independent and establishes the value of the currency. And the value of the currency, in turn, needs a sound tax collection system, which backs up the currency. When you have all of that in place, you have a developed monetary system. And it is a wonder, because with a developed monetary system, there's always money. I have worked in Africa, places like Malawi, where they don't have an independent central bank, where they don't have a well-trained and well-resourced accounting system, where their criminal justice system doesn't uphold contracts. There's lots of cheating, there's lots of fraud, where they don't have a sound tax collection system. And you know what? There's no money in Malawi. There's no money. And poor old Malawians go around with a begging bowl asking the rich countries to give them money. They need a sound, developed monetary system, then they would not have to do that. But somehow the IMF and the World Bank don't encourage them to do that, but that's another story. So a sound monetary system is a wonderful thing. I'm a great fan of it, really. So it's always a relationship of assets and liabilities. So a banknote is a central bank's liability. When you say, here is a pound sterling or a Norwegian kroner, and it has this value, the central bank has a liability to maintain that value and to give you that value. But it's an asset for me. I can buy coffee with it. A bank deposit is a bank's liability, but a client's asset. A government security is a government liability, but a pension fund, for example's asset. And a corporate bond is a private company liability, but it is an investor's asset. Right? So that's the relationship of money. So this means that when we discuss financial savings, we are also discussing debt. Every penny saved is someone's liability, and in a monetary economy, savings do not fund activity. They need to be funded. This is Andrea Terzi, who's an Italian economist and who's also at INET, whose work I strongly recommend. So this is a really big issue, because we've told that debt is a very bad thing, and it is a very bad thing if it is unpayable. But it's also fundamental to the financial system. Right? At the moment, we have a shortage of debt. And I'll go into that because that's a concept economists rarely balk at and really find difficult. So then I want to because this is my passion, I want to talk about this thing, which is the price of money. Now, it's not, the price is a crude understanding of it, but nevertheless, it is something that it gives you some idea of what we're talking about. And I love this chart. This is a chart that the Financial Times published soon after the crisis, and it's in nominal terms. It's not inflation index, but it shows you what's happened to interest rates over our history since 1914. And what's fascinating is that, you see, this period here, we see volatility in interest rates. The general strike, there's great big financial crises going on, and then we have 29, and the whole thing blows up. This is the dagger in 29. And then what happens then is that in Britain, John Maynard Keynes becomes influential at the Bank of England and at the Treasury, and in the United States, Roosevelt is elected. And the banking system is subordinated to the interests of democracy. And Roosevelt is underestimated for the role that he closed down the banks on day one. His inaugural speech is on a Saturday. On Monday, the banks were closed, right? And he called them in, essentially, and he said, you guys, you know, I'm keeping you closed until you get your house in order, and we will back you, but there are terms and conditions. And furthermore, he was invited to go to a global conference in 1933 of orthodox economists who wanted to restore the gold standard that had been the cause of all this turmoil here. And he wrote them a letter and said, piss off, I'm not coming. And that collapsed the global economic conference, and it collapsed the global economic narrative around the gold standard. So between, oopsie daisy, this is too clever for me, this thing. So here, this is the period that Keynes is in charge of interest rates. And this is the week he went on holiday. So Keynes takes charge of the Bank of England, and he says, look, we've got a lot of debt. We need to recover the economy. We need to finance that recovery, but we can't make it very expensive. Because, you know, we've had the general strike, we've had a crisis, we've had a collapse of industry. The private sector is on its knees. We have to help it. We've got to keep rates low, and he does that. And he does that throughout the period of the Second World War, when Britain borrowed more money than it had ever borrowed throughout the history of its economy. At the end of the war, debt was 250% of GDP, and interest rates were still low. He kept them low. And they stay low until the 1960s. And then by this time, the banks are getting very restless, and they're beginning to put pressure on it. And the rates begin to rise. And they peak under Mrs. Thatcher. This is one of her great achievements, is that interest rates hit the roof and bankrupt all of the private companies that she was so fond of. There was I've forgotten its name now, a small airline company that opened up, the first sort of easy jet of our time. What was it called? I've forgotten. But he went bankrupt because he had a load of debt, and interest rates broke him, basically. And the day after that, Mrs. Thatcher knighted him, you know, as consolation. But anyway, so this is what's happening. This is what's happening with liberalization of this is when you ignore Keynes. It goes like this. Now, these are not corrected for inflation, so they're not real in that sense, but they give you some idea of the sort of volatility and the turmoil. And then what happens with the crisis is that in 2000 we have the dot-com crisis. And this is kind of also unexpected. You know, we've inflated this massive dot-com bubble, and we're very surprised when it blows up. So Mr. Greenspan brings down interest rates dramatically. And then he starts ratcheting them up. Slowly, slowly, he ratchets them up. And I'll show you a beautiful chart which explains how that happened in a minute. So the interest rate, for me, is absolutely causal of economic activity. It is for Keynes. And it's not the passive consequence of economic activity. So most orthodox economists argue that it's the result of what's going on in the marketplace. He believed that the level of investment, employment, and trade was determined by the rate of interest, not that it was a consequence. So the classical and neoclassical demand and supply view is that the rate of interest is determined by the demand for and the supply of savings. By the way, have I got you? Are you all with me on this? I'm not going too fast, I hope. I see someone's already asleep, so that tells me something. So the thing is that the orthodox view, taught, I think, in most mainstream economics, is that there's a limited supply of savings because there's some very prudent people that have been saving, not like the rest of us, you know. And we borrow from them, and they determine the price. And Keynes was very clear that that's not true, that the rate of interest is determined by the demand for and the supply of assets, especially government assets, debt or bonds or gilts, right? So basically, people are prepared not that people are paying a price not for the ability to access savings, but for the ability to part from their assets over a period of time, to part from the liquidity of their assets for a period of time. So the demand for assets, he argues, the liquidity preference that investors have, determines the rate of interest. And there are three motives behind this demand for assets. The first one is the transactions motive. People prefer to be able to convert quickly to cash. I'm going to leave my money overnight with some shadow bank somewhere, but I want to be able to cash it in tomorrow because I want to spend tomorrow. But in the meantime, I want to make something on that. The precautionary motive, I want to leave my money for 30 years because I'm going to retire in 30 years and I want to know I've got some income. And then the speculative motive, which is I know more than the man in the street, definitely, and probably not more than the man in the street, and therefore I want to take a gamble because I know something's going to happen that they don't know about. So those are the three motives, he argues. And what the central bank should be doing, he said, is providing those assets to meet those various preferences, those various liquidity preferences, and that determines the rate of interest. And the reason why he could manage the rate of interest during that period was because he insisted that the central bank should provide those assets for investors so they could put their money into that, and that would then begin to shape the interest rates across the spectrum of lending. Now, you need to know that with the abandonment of Keynesian theory, the market said, oh, well, the bank doesn't have to do anything to fix the rate of interest in the real economy. We can trust the market to do that. You know, the market knows best how to price this. But the central bank, yes, the central bank can still carry on fixing the interest rate for banks and for financial institutions, not for you and me. For banks and financial institutions, they can do that limited activity, and then that may influence the rest of the spectrum of rates, but, you know, let's leave them just to do that side of the work. So whenever we talk about interest rates, we normally talk about the bank rate, but the bank rate is just for those privileged enough to use the central bank. I don't pay 0.0% on my borrowing when I exceed my credit card use. I pay 28%. Okay? And when I'm a small business and I'm starting some new risky enterprise, I don't pay 0.25% or 0.5%, which banks are currently paying, and financial institutions on my borrowing. I pay 5, 6, 7%, and that is very high relative to my expected profits on that enterprise, right? So we have a problem. Anyway, so in a bank money economy, society is no longer dependent on those with savings or a surplus for finance. Those with accumulated capital no longer are the sole providers of finance. Savings are not needed for investment. We've overseen the euthanasia, if you like, of the robber baron. So, but they have to find outlets for their surplus capitalists, and they want to retain control over the period they're willing to part with their liquidity, and that's the key thing for deciding the liquidity preference. So, as I said, Keynes argued that it was important that central banks should do that. And so we've seen now. I bring you to today. So this is a gorgeous chart from Fred, which is the St. Louis Bank, Federal Reserve Bank, and it shows you the progress of charts over history. This is a very difficult chart to develop, so one has to be in awe of the economists that create this chart. But you can see we've had, whoopsie daisy, sorry, we've had this period of stability of the federal funds rate, or the base rate. Here it's the federal funds rate, the base rate. And that's been marvelous for people paying this rate. But for the rest of us, it hasn't really been true. But even so, it has helped to depress rates across the board. And now we're doing this, right? This is the dangerous point that we're at. So I wanted to show you this. I love this movie. Have you all seen The Big Short? If you're an economics student, it's actually, you know, it has to be on the curriculum, this movie. Anyway, I love the scene where she's on the pole. She's doing the pole dancer, and the Wall Street guy comes up to her, and she's busy. She's got no clothes on, and she's swinging around, and he says to her, have you got a mortgage? She says, yeah. He says, have you got a variable rate mortgage? She said, yeah, of course I have. He said, wow. He looks at her because he knows that all she's got are these tips, these dollar notes falling at her feet. And she says, furthermore, she says, I've got 5 mortgages. 5 mortgages for a pole dancer. Goldman Sachs couldn't believe their luck, right? Because when you lend money to a pole dancer, you don't charge her 0.5%. She's a pole dancer. Her earnings are variable. You charge her 15%. She's the most profitable customer in your business, right? And you sell 5 mortgages to her. And eventually this cookie here, plus the others, blew up the system. And one has to be thankful for small mercies. So this is what happens. This is Richard Koo's chart, which shows you what happens to interest rates. Mr. Greenspan, here he is being frightfully cautious, going up, 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 until eventually the dagger reaches a point that blows up the system. And it's come down again, and now it's going up. So what do we do to manage this? Well, at the moment, the economics profession says, really, you must trust the market. The market understands all this. Don't worry. We don't have to worry. But as far as I'm concerned, the market has something like $293 trillion of financial assets and liabilities. And the global income, the global output, is $76 trillion. Now think of your own mortgage. You have a mortgage of $293 trillion and you've got an annual income of $76 trillion. Are you going to be able to pay back that mortgage? Well, you never know. Over 30 years you might be able to, you know. But the thing is, what economists say to us is you don't really have to worry about this at all, you know, because what Joe Bloggs could do, what the pole dancer can do, is to sell her asset. And then she could pay for her debt. But nobody pays for their debts by selling the roof over their head. Nobody pays for their debt by selling their assets. And I can tell you, when they start selling their assets, that's when you ought to panic. Right? That's when the panic begins. So this is my worry. We've got all these liabilities. We've got pathetic income. And the recovery, despite massive injections of liquidity by the central banks, which have been maintained. They're as high in 2017 as they were in 2009, the trillions of dollars pumped out by the ECB and the other central banks. And yet recovery is just doing this. We're just coming off the floor. We come off the floor and then we fall back again. So the global economy is like a semi-comatose body. Every so often we pump liquidity into the body and it goes, and then it collapses again. And right now, there are more signs of weakness in the United States economy, the European economy, and the British economy. And everybody's saying, tut, 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 we thought it was on the up and up, right? So our global income is still pretty pathetic, given the amount of liquidity the central banks have pumped in and the dependence on monetary policy and the refusal to use fiscal policy. So on that cheerful note, I'm going to stop. Thank you very much.
Takk for invitasjonen. Jeg skal holde et nokså nøktern foredrag. I'm going to take you down to the Norwegian realities. Because I think the financial market we live with in Norway is more safe, less dramatic than what we have heard. And we have a special history. With a lot of regulations. We have had more regulation in the Norwegian economy, the Norwegian banking market, than perhaps any other Western countries. It all started back in 1945 a strong Labour government, wanted to rebuild Norway after the war, manufacturing and housing. The aim was that every Norwegian should own his or her own house. We should do away with the tenant system where you lived in other people's house. We had organized a state housing bank, and there was full control, full regulation of all banking activity. And this functioned quite well from 45 to 78, which coincided with the Bretton Woods period of stability. Low inflation, low interest rates, low tax rates, and regulations worked with small tensions. The real interest rates were around 1%. It costs something to borrow. Okay. So the tensions behind the regulations were moderate. But then came a period in the 70s where higher inflation and also the tax system had not been adjusted to higher wages. So the marginal tax rates moved up to 48 for industrial workers, 67 for top income earners. But that was also because this was taxes on net income, the value of deductions of interest rates. So after tax, the real interest rates became negative. And banks started to put pressure on the regulation, wanted to lend more than what the quotas were. At the same time, we had a radicalization of the labor movement. I joined the Labour Party after having been på Utøya as a young AUFer, and I organized protests against apartheid and against the Vietnam War. But then I studied economy and joined the Ministry of Finance as a student already in 1968. We were in Labour Party on the 70s, not satisfied with the private power of banks. So we had a majority, first in the Labour Party and then in Parliament, SV, left-wing socialists, who supported socialization or democratization of banks. And that we had in operation for 5 years, from 77 to 82. The owners of the banks were put into a minority. The majority were appointed by local countries, other government bodies. What we discovered later was that this having people on the boards of banks didn't change ordinary people or elected people, didn't change the bank behavior very much. They were eager to expand their activity. And then we had the problem that the tax system had made interest rates negative. So my boss, Per Klippe, I was then deputy minister in the ministry, he wanted a tax reform where we had a progressive element put on the gross income, not on the net income. But that was turned down by both the right wing and the left wing, because it would have given in a period some somewhat larger tax reliefs on higher incomes to get the marginal tax lower. So what then Then we had a change of government. The right wing came in, and then in 1st January 84, they lifted all regulations on the banks. And the banks had been waiting for a free market. So they doubled their loans in 3 years, 84, 85, 86. And then, of course, house prices doubled, 83, 87, and then halved, 87 to 92. A typical boom and bust. And most people felt that this would go well. I mean, we hadn't had a crisis since 1920s. But we got a banking crisis, and it happened to be exactly as Labour came back. So it was the Labour government, and then I was head of the Prime Minister's office, who got the task of overtake the 3 major banks by government. There were no private capital available, but we had principles. When private shareholders were not able and willing to keep up the banks, keep up own funds, they should have no compensation. So it was fully overtaken government banks. And also, the people of the banks, they should learn from their mistakes. They should roll back the credit which had been wrong. We shouldn't organize these bad banks. They should learn it themselves. And I think this worked. And I think the lessons learned from the banking crisis is the main reason why Norway came better through the international financial crisis than perhaps any other country. We got broadly based tax reforms, reducing tax on net income to 28%. It's now down at 23%. Kleppe chaired a broad party commission on how to modernize monetary policies. And we had to, I mean, the regulations had broad support, carried through under conservative and social democrats throughout the 70s and 60s. But when we made analysis, it was clear that the lack of competition and the very high levels of investments had made productivity growth in Norway lower than what it could have been. I mean, there was an over-consumption of capital as one of the results of the regulated system. So we wouldn't go back to bank regulation. We would have interest rate policies to gear. I mean, Keynes believed in interest rates. We believed in interest rates. So that was the main instrument to steer demand and supply in the markets. And then from 2001, we got the inflation target, 2.5%, now 2%. There was problems in the Kredittilsynet FSA, and the Minister of Finance, Sigrid Johnsen, asked me to steer it. And then we raised minimum requirements for bank core capital to 7%, way ahead of international regulations. We strengthened the FSA from 99 to 265. Many with bank experience, large number of on-site inspections. We didn't trust the banks. We looked after them. And a lot of guidance and training, regulation requiring internal controls and internal audit. But in general, the banks admitted that their internal systems had not been up to a free market. They had to improve their internal system. So it was basically a quite constructive cooperation in these years. And then there was a general cautiousness on asset-backed securities. Both the ABS and the CDOs, very few Norwegian banks bought them. And Norway, Norwegian banks, was the country who was most skeptical to Icelandic banks. Icelandic banks sold their bonds to Germans and English and also other, but in Norway we had, from the supervisor, said that Copting couldn't buy too much shares in Storebrand because they had too weak capital and didn't know insurance. That was a signal to the banking system, be careful with Icelandic banks. So Norwegian banks, although we are neighbors, bought less bonds from Icelandic banks than any other country. Then when the crisis struck the Lehman Brothers, well, we had established a good cooperation between the ministry and the bank and Finanstilsynet. In just a couple of weeks, a quick swap arrangement was made with covered bonds based on housing loans and treasury bills. So we solved the liquidity challenge very quickly. And Kristin Halvorsen, left-wing Minister of Finance, was very able and quick to make decisions. She named it the golden card, the gullkortet, that you could use these covered bonds to get liquidity, and neither the banks nor the central bank nor the ministry was seen as taking too much risk, because it was based on loans to Norwegian houses below 60%. So it was just an elegant circulation of securities. So solid own funds gave, well, I must mention that what was perhaps a little exception for Norway was that Kristin Halvorsen and Jens Stoltenberg, they could expand the budget by 1%. We had oil money, and this helped the general economic situation, of course. 20 billion kroner, close to 1% of GDP. But the banks were solid. There were no Norwegian banks hit by the crisis. Losses in Norwegian banks were at 0.5%, while losses in UK banks was 3 or 4%. So it was a totally different scene. Lending was kept close to normal levels, and fortunately, oil incomes kept up well. One background for this was the crisis we had back in 91, 92. We were afraid it could come back. We did a lot of exercises because we had a feeling that there are risks in our domestic system, in the international system. So we had a different kind of preparedness. And Norway had a very good credit growth. Now, that is perhaps a little lacking in Ann Pettifor's the way you present all the money creation. The main problem after 2008 was that credit was reduced in the Eurozone. So the Eurozone, the Euro system, is not a success story. It's a pity to say. They were split between Germany with surpluses and good competitiveness, and then when they had the same exchange rates in Spain, in Portugal, in Italy, Greece, they could not devaluate. So the problem was that in order to improve competitiveness, they had to tighten. And so credit didn't grow, activity stagnated. Here you can see the Norwegian GDP bounced back after only 1 year of stagnation and continued growing afterwards. While you can see here, many other countries had a big dip of activity. When we then look at the Norwegian financial market, we do not speak much about money. There is very little focus. The quarterly monetary policy report from Bank of Norway gives no figure for money. It's not part of our economic debate at all. But there has made very good historic analysis. The reports produced by the Bank of Norway for its 200 years anniversary give very good analysis here. And the last 10 years, there is a perfectly stable relation. The stock of money, the M2, broad money, has been 60% of GDP throughout that period. Loans have been relatively stable at 160% of GDP. And we don't have any English or American banks, which are the kind of banks my colleague here hates. So our banking scene, the largest bank, the Norske Bank, owned by the ministry, by a saving fund, and some others. We have 1/3 of the market is 100 savings banks, and Norwegian Savings Bank, they by themselves and by the push of the supervisor, they had very good capital adequacy. They had, in general, 12 to 15% own funds. And they are governed by depositors, local communities, and employees. Some have now shares as well. I mean, they are serving society, and they know it. We have a few foreign banks, Nordea and Danske, Swedish, Danish, some small others. We still have state banks, some 7%. So the Norwegian market is not governed by a large and aggressive financial elite of bankers, the kind of bankers which Ann comments on here and in her book. There is a good dialogue between authorities and banks, and in general they behave. There is one very clear exception, and that is the aggressive consumer credit banks. Many of them newly formed and with one single idea, selling as much consumer credit at high rates as possible. And then, of course, our general economic situation is that our government owns more than 50% of the shares at the Oslo stock market. In nearly most major companies have strong government stakes, like Statoil, which I hope keep their names. But here we have the situation which worries us today. On the left, you can see debt. It was reduced after the situation of the 80s, and then started climbing at the start of the new century. And it has been climbing quite fast and is now at 225% of the incomes. And that is the high end of international borrowing. The cost of it is lower than ever. In Norway does not have the lowest interest rates, but the interest rates paid are lower than ever. But we feel that these high household debts is an important part of the risk. There is a risk of declining house prices when interest rates rise from 2.5%. And I mean, we borrow a lot. Normally, it used to be a change around 50, then deposits would be higher than loans. Now, loans are higher than deposits for all people until they reach, in average, 65. So we are exposed, even some of us who are older than 65. We have a more radical regulation of housing loans in Norway than in other countries, but all the Nordic countries have such regulation now. It's a roof, 85% of value, and 5 times income. But it's very important that these regulations will be carried forward, and the FSA have given a clear advice for doing so. In general, the international capital requirements are too low. We have 8% in Norway. If you take the leverage, own funds, total exposure, many other countries have only 4 or 5. There's a lot of risk of Trump. Trade wars, military conflicts, and I am afraid that weakening, the construction of the Eurozone was basically wrong, but it would be a wrong moment to dissolve it because ECB has helped some of the countries. And the problem now with Brexit is that the EU as an institution is being weakened. UK becomes more isolated by Brexit, of course. We have to recall, most of us who are Norwegian in this room, we remain an outsider. We will have little sympathy and support from abroad if anything goes wrong. We can only rely on ourselves, strong banks, and strong authorities. Thank you.
So Bjørn, that was fascinating and also so interesting to see what happened in the 1980s here and in the 1992 banking system. And we are all deeply envious. And can I just say also that I think the British government is heading towards a Norway solution when it comes to Europe, basically. So I'm very glad to be here to learn even more. And I also want to say that I don't hate banks, Bjørn, really, and I don't hate bankers.
Sounds like it.
I know it does, and I realize that I should have changed the tone of my book, really. But I suppose, I feel that the financial system governs public policy on the whole, and that we're subject to it, and that we're subject to its crises, but it's not in a system that's accountable. We can blame the government, we can never blame the bankers, because they're sort of and by the bankers I mean the financial institutions. But I know that a sound and well-managed monetary system is absolutely wonderful thing, and that banks are part of that, and if they play their part, as they seem to have done here in the 90s, it's really good for the economy. So but I want to thank you for that, and I would like to see your notes as well. I just simply want to say that my experience, though, increasingly, is that the financial system isn't domestic anymore, in the sense that, yes, of course, savings banks are domestically based, and if lending is based on existing savings, that is, on the whole, likely to be a sounder system. But most banks are effectively global and participating in global markets, and sometimes to an extent that we don't even know about. I'm always struck by the fact that the first banks to go down were German banks. The first crisis on the 9th of August 2007 was a German banking crisis, and it wasn't even the big bank. Deutsche Bank is the problem now, but then it was the small regional banks that had been foolish enough to buy these asset-backed securities and were in difficulties. But no, I think and the other thing about Norway, of course, is that Norway has fantastic assets, has oil, and as long as the oil price is going up right now, so that's good news for Norway. But it's also obviously going to have to be a problem to be thought about in the future, because there are limits to the amount of oil that we can burn. But so sorry, but I would really welcome Bjørn's contribution.
I would like to add that one of my first tasks as a junior minister was to present an analytical paper on the role of the oil in society back in 1974. Does it work? It doesn't. It works? Yeah.
We can hear you.
And the main message was that we shouldn't spend the oil income, because that would produce too large transitions. And then later we got the oil fund, and so we have saved most or a very big share of the oil incomes, and there is a discipline. I think the present government has used too much oil incomes, but it has of course helped the economy. But we are vulnerable if we continue to spend as much. Then it will last my generation and some younger, but there are some young ones among you who may not have much of oil income left. So there is a warning of caution here.
I want to ask one question to both of you before we open the floor for discussion. Anne, I know you have some proposals as well as how we can to regulate the banking sector. And Bjørn, you mentioned that the capital equity levels internationally were too low currently. What kind of level do the capital requirements need to be on? What is necessary, but also what is the right level? How far can we go? And also, or is it a good measure at all? Should we do something else? Other kinds of regulations.
Should I go first? Well, I have. As far as I'm concerned, there is only one important intervention that governments and central banks should make, and that is management of capital flows across borders. And I believe that because I know that it's not possible for central banks to manage interest rates across the spectrum of lending unless they also manage capital flows, but also that speculative capital flows are so destabilizing of economies and have so inflated bubbles and created imbalances that it's about time that we manage them. Now, that's regarded as extraordinarily radical. And, you know, I think it might be why Bjørn thinks I'm so anti-banks, because banks think that it's unthinkable to manage capital mobility. But I'm noticing that more and more economists are talking about it. I know that, for example, China exercises capital controls. And I know that we may well get them from other states soon. I noticed, for example, that Donald Trump said that unless the Mexicans were prepared to pay for the wall, he was going to stop Mexican capital flows across the border from the United States into Mexico. Now, you know, that's just talk, and nobody really trusts his talk. But I would not put it past a big behemoth like the United States to, in a crisis, put up capital controls. But the problem with capital controls is that what is needed is international coordination, so that governments and central banks work together globally to stabilize capital flows. And that is just not on the agenda at all. You know, my government is very proud of the fact that we have undermined the G8 and the G20 in a sense that there's not sufficient coordination, and that we all go our own way, basically, that every country is on its own. So the idea of governments and central banks cooperating to stabilize capital flows is slightly utopian as we things stand. But my fear is that we are going to get capital controls, but in a crisis, and they're going to be put up irrationally and, if you like, in an uncoordinated way, and are going to make things worse. And then from that, you know, there's other macroprudential tools. New Zealand at the moment is considering banning foreigners from owning residences in Auckland, in their country. Now, that's a form of capital control. It's a macroprudential tool. I don't know if it'll work, but governments are beginning to start thinking about that. And there are economists as well. And the one that I would like to recommend to you is Professor Helene Ray, who's at the London Business School and who advises central banks and so on, who has said there's absolutely, well, she said there's very little evidence of benefit from mobile capital flows on society, and that we should be doing something about it. So I'm hoping, because she's quite influential, she's an orthodox economist, she is an advisor to President Macron, I think, as well as others. So I'm hoping that behind the scenes there is consideration of this, but I'm not sure that that's going to happen. But that's just the sort of the big picture, but of course there's lots of other kinds of controls, like the ones that Bjørn has talked about already, that can be applied locally. Can I just say, Bjørn, that I think loans at 5 times income is still very high. When I was young, which was a long time ago, you know, to borrow more than 2.5 times income was considered kind of bold.
But the roof of 5 times income has worked. It's not reduced loans, because we had a number who borrowed 6 to 7 to 8 times income.
Right.
And in the loans, you have to include all kinds of loans.
I see.
Student loans, consumer loans. So it is effective.
Not just against property.
No. Okay. But it is practiced on property, because that is where it's applied on the banks. Mm-hmm. So this regulation has, and then we had a special regulation for Oslo that you needed a 40% own capital to buy a secondary flat, because we had a speculative wave in the Oslo market, like New Zealand.
Yeah.
And I think we should maintain that. I'm open to cooperation on controls of international movements of capital. We had it in Norway until 91, so we could go back to it. Norway, as such, is not dependent, because we have a big surplus, so we are not exposed to speculative movements here. But we can see a number of examples that other small countries have been exposed to quick movements, so some kind of controls on those movements I think we should have. And then I think the present international requirements on capital are far too low. They should, and it will take a long time now to get even the modest improvement suggested to have, you know, what makes the capital requirements very vulnerable to changes is the risk-weighing system, where the banks have their own models. In Norway, we have very strict rules for controlling these models, but that is varying quality, and the actual coverage of capital with these models. So you should have floors, and then the agreement is that the floors will not have full effect before 2027. So it's a very slow process within the Basel Committee, and I think the level we have in Norway of 8% out funds towards total bank leverage should be an international minimum, not the 4 or 5 we find in many countries. So of course, introducing it will take a period, but the aim should be a much higher level to safeguard the system.
Okay. Any questions, comments from the audience? At the back.
Yeah, I can.
You're getting. We need to record it. So.
Ah.
No, it's maybe a question to both of you, or but maybe first of all to Ann. I mean, the way you present, and that's in a sense an old story, that money is a promise. But I mean, the point I would just like to ask you here is and I come from a tradition or a position where we discuss a lot about the financial system's impact regarding the sustainability of the economy. I'm not into this business in the sense I don't study finance, but so I maybe be wrong in my assumptions here. But anyway. If the cost of credit or the cost of money is what regulates how many promises that can actually be realized in the sense of who can get credit, and that has to be related somehow to what the real economy can produce in the future. This is like a rent in the normal sense. It could be a resource rent. My question is, why is there somebody that can earn money from doing that kind of regulation or promises? That means why should banks even have the right to earn this money from creating the credit? Because there is no cost of creating it. It's just they do a social role in keeping the total credit close to what the future can deliver. And that's where I'm interested, because I'm interested from a sustainability point, what can really future deliver.
Yeah. Are we answering one at a time or waiting for?
One more first, another question.
Thank you very much. I'm Olav Lundstøl, Policy Director at NORAD, Norwegian Agency for Development Cooperation. I have two comments or two linked observations. One thing is that I feel yesterday and today perhaps there has been some mentioning of the role of accounting, but I would like to just state that I think maybe next conference should be called Rethinking Accounting.
Yeah.
Because a lot
absolutely.
of these issues we are discussing, obviously financial system have to do with accounting.
Yeah.
And I want to say that I think the underlying of a lot of the issues, problems we are discussing is also linked to where have accounting standards been moving.
Yeah.
International accounting standards and as nationals as well.
Yeah.
And who are setting them? I mean, it was an interesting graph yesterday that showed on financial regulations who are influencing. It's exactly the same on the accounting business.
Yeah.
And this is a big issue, and it's an issue also that is very scary in the sense that what we see internationally, perhaps not so much in Norway so far, is this issue of the balance sheet approach to financial results.
Yeah.
This, in turn, has been driving issues linked to debt and issues linked to the crisis, I would say as well.
Yeah.
And it's in turn linked to the issue of tax havens, secrecy jurisdictions, a lot of money being parked for saving tax and for a number of reasons that have again created a huge demand for debt to finance actually paying out of dividends by this crazy approach really of the balance sheet approach spilling into and being allowed by the accounting standards and being allowed by the authorities to some extent as well, where dividends, huge dividends are being paid out based on potential future values that are already now, and we know from the Enron scandal. So I would just like to put this issue on the table and hear a little bit, perhaps now and a bit later, reflections on this, because I think, you know, finance, accounting, and economics, this is all related.
I agree.
Yeah. So I think we agree with, I agree with both comments. I mean, first of all, you're absolutely right that, and Keynes said, why should the banks charge anything for something which costs them virtually nothing? You know, I'm happy for them to be given an administrative fee for acting as the go-between, but not for you, as you suggest, for making a claim on the future. And I get quite annoyed with my friends in the green movement who operate in a silo, and I think there's a point you're trying to make as well, that they worry about resource limitations without worrying about a financial system that is extracting resources from the future now. So the rate of interest extracts resources from the rate of interest determines how many forests we have to fell today to pay for our debts, really. And unless we understand the link between this out-of-control financial system and our ecosystem, we're not going to be able to challenge. It seems to me we're focusing on the ecosystem without focusing on the financial system that's exploiting it. Of course, of course, of course. Of course, you know, why would you want to lend money at 0% if you could lend it at 15%, you know, and sit on your butt and collect 15% of rent for the next 30 years, you know? I mean, why on earth would you want to dig the soil, you know, build a wind farm or do any of that hard work when you can just sit on your butt and collect rent? And they love, and if I'm angry, Bjørn, and I am angry, and I'm not going to understate my anger, is because it's so exploitative, not just of the ecosystem, but also of humanity. And furthermore, it is creating more crises. You know, right now we have the crisis of the rise of fascism in Europe. And that makes me very angry. It is not necessary. We should not be in this position.
But you can't blame it on the banks alone.
I can. I can. You may not be able to, but I can. Right. So I'm not the banks, the financial system, but also primarily the politicians who allow the financial system to get out of control and so on. So I think it's a really important point. And secondly, your point about my problem is that I have an aversion to accountants. And also there are so many of them in economics, you know, who believe the economic system is just a matter of... But the thing about whether or not they're valuing balance sheets properly is so important. It's very easy, in my view, to value liabilities. Valuing assets is a different story. And they're not doing it correctly. They're being bribed to not do it correctly. I mean, the rating agencies, for example. But also, I think, as you say, this, the big four and the corruption of the fact that, you know, they now are so concentrated, that we are not talking about that enough. And so I can only agree with you heartily. Thank you.
Hello, everybody. Thank you for both the presentations. And you mentioned the movie The Big Short, which has been the vehicle for popular understanding of the great financial crisis. The story of the great financial crisis can be told in two ways, and this movie, as I see it, has been a story of individual fraud by originators of loans, of individual Wall Street companies, created secure toxic assets and insured them and bamboozled and so forth. But didn't the movie miss the perhaps more important story, the systemic story, which Hyman Minsky did so much to develop and elaborate, that the system, whenever there's stability, this fraudulent activity and this innovation that is called, is systemically induced. Shouldn't we be talking about that story and spreading that in the public sphere and asking what kind of transformations should be done in order to limit it?
Can I answer that straight away? I mean, after all, this is an American movie, for God's sake. I mean, you know, what more can you... But you're absolutely right. You're absolutely right. And I should have said that as well. I mean, the other thing is that, you know, if you think about the economic system, if you think about aeronautical engineers, you know, they build... I've just come across the seas in something called an Airbus. I mean, I've never been in anything so big. It's horrible, really. But it's huge. And this Airbus has carried me from New Zealand to Oslo, right? And we haven't fallen down. So that's down to aeronautical engineers that have created a system and created a structure which has kept me stable in the air. And that is a miracle, really. I don't know how on earth they do it. But when that thing crashes, if it crashes, we're not going to blame the passengers. We're going to blame the aeronautical engineers, are we not? But when the financial system crashes, we blame the pole dancers. We don't blame the architects of the finance. And those are economists.
Hi. If controlling capital flows is utopian, as you describe, what else can national governments do in the absence of international coordination?
Right.
What would you recommend?
Bjørn, do you want to answer that one?
Yeah, to add to this maybe, because it's again about regulation, this is a question I was thinking to ask in these 2 days. I think now it's a good moment. Talking about the Chicago plan. So this plan developed by Fisher, economists in the 30s, and then which was actually revisited by these two economists, Bennis and Kumhoff, of the IMF in 2012, proposing 100% reserve banking and like shifting the burden of repaying public debts to banks rather than to a government. So maybe a comment on this related to what governments can do now to fix the issue.
Yeah.
Thank you.
Bjørn, are you going to?
Just one more question.
Oh, right.
Abba?
Oh, thank you. Okay, I'll just take the microphone here then. Yeah, I have a question. I mean, one of the problem, I guess, is sort of the big banks. The big banks are really testing out the new and always pushing boundary and creating a lot of credit. And then you have the saving and loans bank, you have the smaller banks, you have the social banks. And if some of them, to what extent, well, when you're trying to regulate the big banks that are too big to fail, if those, if those things will in fact make it difficult for what I look at as being the alternative. We could go by building up the banks that are doing the more traditional banking, but if they are destroyed by the regulations that are trying to take down or to regulate the big banks, we might have a problem. Yeah.
Okay.
Well, my general feeling is that the kind of capital requirements which Norwegian authorities are practicing could be practiced by other countries as well, and we could go even further. But there is not a big difference but what we apply to medium-sized and big banks in Norway. So it's the savings banks are quite solid for the moment in Norway. So you should trust them.
So the first question was, what could governments do? And governments don't, in the absence of globally coordinated capital controls, they have macroprudential tools. So, for example, in London at the moment, 80% of bank lending is aimed at speculative activity in the property market. And now the central bank's beginning to put restraints on that, saying deposits have to be higher, and so on and so forth. Those are all kinds of macroprudential tools that you could use at a domestic level to manage capital flows. Now, a Russian oligarch has to pay $2 million to be able to come into to get a visa, whereas before we only paid $1 million or something. I mean, these are ways in which you can manage those. I'm not an expert on macroprudential tools, but it is possible for governments to take some limited action at domestic level to manage capital flows. But having come from New Zealand, I find it really hard to know how governments can respond. These markets are global markets. They're out there in the stratosphere. They're beyond regulatory democracy. And it's not just the financial market, it is also the property market. Auckland is a global city. It's got nothing to do with New Zealand. If a Silicon Valley billionaire wants to buy land in New Zealand, tough. New Zealand can do nothing about it, right, effectively. And so really it's about constraining those markets and making them accountable. And of course there's also the market for labor, which in the case, for example, of New Zealand is definitely global, And it's these flows which are volatile and unstable, which are so destabilizing society. And then as to Kumhoff and so on, in my book, I have a whole chapter in which I sort of disagree with that. For me, it's just monetarism. And monetarism is deeply flawed, in my view, because of its failure to properly understand money. And someone said that this is a very old story. You're quite right. It dates back to 1694, since we've understood money. And 1705, I think it was, when John Law first wrote about money and understood money. But still, our people like many people, including many people on the left, still don't have a proper understanding of money. And so what I don't like about the Kumhoff and Bennis proposals is that, again, it's about nationalizing the money supply, essentially, and someone at the top preferably a technocratic elite, determining the money supply for a nation. And I find this extraordinary, really. It's a sort of authoritarian diet. When I challenge people in, for example, positive money and saying, who are these technocrats that are going to decide? Are they the same ones that helped us have the financial crisis? You know, the technocrats at the top of the Bank of England had no clue the financial crisis was coming. Are they going to decide on our money supply? You know, the good thing about the way the monetary system works is that it's democratic. You and I decide on the money supply. Whenever we apply for a loan, we expand the money supply. When we lose confidence in the system, we contract the money, we don't borrow, right? So it's a process, it's a dynamic process, which is a bottom-up process. Now, the role of the government is to establish conditions so that I will be confident if I'm a risky entrepreneur and I've got a bright idea about artificial intelligence or something, and I want to take risks. I've got to feel some confidence in that, in my ability to do that. First of all, I want to have a sustainable rate of interest because my project might fail. You know, if I'm inventing the steam engine, do I know if there'll ever be railway lines for my steam engine? I don't know. This is a big risk I'm taking. So you need the government to create the stable conditions in which entrepreneurship can take place and in which people, and you also need government to say, sorry, you can borrow money, but not for speculative purposes, because the income from that cannot be trusted. You must mainly borrow for productive purposes, sustainable productive activity, right? So government sets that framework in which it's possible for us to democratically decide, you know, and to have someone at the top of the world deciding how much money we should have and then contracting it when they think we behaved badly, not for me, you know. So I have lots of real reservations about that framework. There was a third question. Oh, there was this question. I don't think savings banks are sustainable, you know, because they're built on this theory of you've got to have some savings before you can borrow. Right. Now, if I was in charge of a savings bank, it's a nightmare because you have so much money in the bank, then you have this demand for loans, and then you have to get that loan repaid and money come into the bank, and you have to balance your books. And it's a very, very hard thing to do. And we see these little credit companies going bust. We see how hard it is for crowdfunding to operate. You know, this crowdfunding loans on the internet. It's, you know, so what do? They charge very high rates of interest in order to ensure to help balance their books. And then what happens is their borrowers can't repay because the rates are too high. So my problem is that I think it's sweet, but you talk about savings banks as being the traditional banks. They haven't been the traditional banks since 1694 at least, but even before that, since the Dutch bankers and the Florentine bankers were lending money on the back of, you know, backed up by collateral. So they're not traditional. They're really quite unusual, and it's very hard to sustain them. I don't know how you do. So what I would rather see is a proper banking system, properly managed and properly regulated. And even that is hard to do. You know, for a bank to assess the riskiness of a loan and whether or not the rent from that loan is going to come in time to keep the books balanced, they need a central bank to back them up. Our savings banks don't have that kind of or at least not in Britain anyway, that kind of backing from the central bank. So it's hard. Banking is hard enough without savings banks having the challenges that they face. Now everybody feels comfortable about them because they're small, they're local, they know us, and that's really important. Our banks should be small, local, and they should know us. But their model is a very tough one to sustain. Sorry.
You want a quick comment there?
Yes, Norwegian saving banks are solid and you can trust them. And they don't go broke and haven't done so for decades. So that's not... And you have local savings banks, but you also have regional and national savings banks. So everything is possible if you have a decent system.
I think the answer is we should all live in Norway.
Yeah, well, no, you shouldn't, because one of the reasons why we can manage speculation in Norway is that foreigners can afford to buy property in Norway. It's only Norwegians who can do it.
That seems... But what do you do? Do you mean Russians don't buy properties in Norway?
Who?
Russian oligarchs?
No, they buy in Nice.
Right, I see.
On that note, yeah, thank you so much to both of you for your great talks and discussion.
Thank you.